It's 2 o'clock. Good afternoon. I see our chair is there. Prof. Gumede, over to you first, and then I'll come in after you.
Thank you. Afternoon. Greetings, everybody who's here in the webinar. And perhaps just to briefly indicate that this is one of the webinars we are hosting in the series around social protection and employment creation. It's part of the ASSAf Standing Committee on Science on the reduction of poverty and inequality. And thank you so much, Prof. Margaret Chitika-Mabu, who's leading this one for us today, and perhaps to thank all the participants, the presenters in particular, and of course our ASSAf colleagues who make these webinars possible, and the leadership of ASSAf. We wish ourselves well for this webinar, and back to you, please, Prof. Margaret Chitika-Mabu. Thanks.
Thank you very much, Prof. Gumede. A very good afternoon to everyone. It's great to see that the numbers of participants continue to increase. So I'm really very happy to see you. Distinguished guests, distinguished speakers, and we do have distinguished speakers this afternoon, and all the colleagues, good afternoon. As Prof. Gumede mentioned, this is a webinar within the series of webinars we've been having under the ASSAf Standing Committee on Science for Reduction of Poverty and Inequality. My name is Margaret Chitika-Mabu. I'm based at the University of Pretoria in the Economic and Management Sciences faculty, and I'm a member of the Standing Committee. So this afternoon, I'm going to be your moderator. It's a true pleasure to be here. So let me say welcome to the webinar on financing and funding options for social protection in South Africa. I know it's a Wednesday afternoon. I know how busy everyone is. So sincere thanks for you being here. Of course, a very special thanks and welcome to the distinguished speakers this afternoon. We have 3 speakers, and I'm particularly looking forward to hearing from them. I'll introduce them shortly. Their bios are already in our program, so I will not read them out, but I'll say a few words about each. Before this, let me just contextualize the importance of this webinar. I will not take too long because I think I'm preaching to the converted. If you're already here, you probably know the issues. I think it's really a great privilege to have this conversation in our country, in a free forum such as ours. And I believe that the conversation is not only urgent, but it's also very relevant this time in South Africa, particularly looking at what's happening around the globe. Luckily and fortunately in South Africa, compared to many African countries, the issue of social protection broadly is no longer an abstract concept. And for a long time, it hasn't, because already our government provides a protection that touches millions of lives every single day in South Africa. This happens through social grants, part of the discussion today, through public employment programs, subsidized services, and healthcare, among others. So our system is already doing a lot to change lives of people, particularly lives of the most vulnerable in our society. We should be very grateful for this. And just to put this into perspective, just looking at the social grant itself without going broadly into all the other social protection services, our population, let's say almost half of our population receives a grant of some form or other from the government. That is substantial. But of course, it also raises red flags. Why do we need so many people on grants and benefits from the government? We're spending, depending on what you're looking at, but at least more than 4 to 4.5% of GDP just on the grants, but a lot more if you count all the other protection services and financing from the government. But there are a few issues, right? That's why we're here today. So on the one hand, we need social protection, and we see that that need is growing. We're not, at least if we look at the world, we're not in a position that we think it will be falling, a need for social protection. It seems that it might be growing even more and perhaps even faster than we had predicted. We can, if we just look at the problems we have with unemployment, for decades and decades, we're not moving past this 30+% of overall employment. This is appalling. This is even frightening. But if you add to that more than 40% of young people are lying within this band of being unemployed. Of course, here I'm just we're talking about the very narrow definition of unemployment. If we broaden it, we're talking about huge amounts of people who want to work, who are willing to work, but are not able to find work. So this is really a huge concern. So that's the one hand. On the other hand, we also know that the fiscal space to respond is becoming increasingly constrained. And this economy has not really been growing. Actually, growth has been subdued for many, many years. We continue to have a narrow tax base. Is it deliberate? Is it something we can change? I don't know. We will hear from the speakers. But also the current global events and outlook are not helping us. They're not giving us the optimism that we had a few months ago about the growth in South Africa. Meanwhile, we also know that there is ample evidence of the impact of social grants and social protection. And I want to say perhaps it's undisputed that there are positive impacts that span improved livelihoods, welfare, education, job search, increased economic stimulation, improved dignity, among others. So there is no doubt that the social protection, social grants are changing people's lives in a positive manner and also even stimulating the economy. So therefore, this afternoon, I would say that the question is no longer whether social protection is important or not. We've debated this many, many years ago. I hope we all agree that it is important. The question is therefore, how can we sustain and how can we strengthen it in a way that's both fiscally responsible and socially just? So as you can see from the program, this webinar is bringing together a wonderful set of perspectives from academia, from policy, from practice, just to help us think through some of these issues and perhaps also have a debate at the end of these three presenters' sessions. So the discussion today will talk about issues. I must apologize for the noise outside my window. I hope you can still hear me. So anyhow, we'll talk about the potential of progressive tax reforms, of wealth taxes, the potential for strengthening revenue collection, the potential for improving the efficiency of public spending. We'll probably hear this from our speakers. We'll also hear about whether there are other options that we haven't explored, particularly within the current global outlook. So I'm genuinely looking forward to the richness of the discussions this afternoon. And let me use then this few minutes to just briefly introduce each of the speakers so that I don't do it during their speeches. Three speakers, as I said. The first to speak to us will be Professor Eleni Yitbarek. She's an associate professor in the Department of Economics at the University of Pretoria. Today, she's joining us from the US. Thank you, Prof. She will discuss financing social protection in an era of fiscal tightening and declining donor support. She will discuss some of the challenges and opportunities in this regard. Eleni is well known for her academic work and policy work within poverty and inequality spaces. So we look forward to what she will share with us. Our second speaker is Mr. Andrew Donaldson. He's a South African economist and senior research associate at the Southern Africa Labor and Development Research Unit. We know it as SALDRU, popularly at the University of Cape Town. He will speak on financing options for social protection in South Africa. Looking forward to that. Andrew is, of course, well known for his long service in the National Treasury, including in the Budget Office. We're looking forward to the discussions, Andrew. Then our third speaker is Dr. Gilead Isaacs. He's the Executive Director at the Institute for Economic Justice. Again, we popularly know it as IEJ. He's also an economist at Wits University. He will share with us his thoughts on progressive tax reform and the research that they have done, and also world taxes as sustainable financing for social protection in South Africa. Of course, we know Gilead very well in terms of his work on social justice, including work on the minimum wage, very famously in South Africa. Each of the speakers will have 15 minutes, and we're going to try to keep you to 15 minutes. When the 15 minutes is up, I will switch on my camera just to indicate to you that this is time to stop. Please do then wind down if you haven't done that. In the meantime, to all our audiences, please use the chat for any questions, for any comments as we go along, and we'll come back to this. You saw that we have 25 minutes at the end of this session, just again to engage with your comments and your thoughts and your questions, if any. So with that, let me invite Eleni to the floor. Eleni, the floor is yours for the next 15 minutes. Thank you.
Thank you, Prof. Let me make a view full screen. Thank you, Prof, for the kind introduction. Good afternoon, everyone, and thank you for joining us. So today I will briefly talk about financing social protection in an era of fiscal tightening and declining donor support. With a particular focus on how these goals, this global and regional pressure translate into policy choices in Africa in general and particularly in South Africa. And during my presentation, I will just simply try to answer one central question, right? As physical space becoming more constrained and external financing becoming less available, how can countries sustain and finance social protection system, which are quite important and play a critical role in promoting inclusive growth. So in my presentation, I will begin with the broader African context and then I move to South Africa, and finally I will just scratch the surface for the next speakers by putting some financing options which I think are a way forward for Africa and for South Africa in particular. And discuss a little bit on what it means for policy. Yeah. So I mean, let me begin with the fact, with three facts, right, which defines the current social protection landscape at the moment in developing countries and particularly in Africa. First, as most of you know, social protection coverage in Africa is low, right? Despite the significant expansion we saw over the last 25 years, only 70% of the total population receive benefit from the government. And second, physical pressure have been intensified over time, particularly after the pandemic. Debt levels and debt service costs have increased, and many countries are now looking into a physical going through physical consolidation. And finally, in general, donor support is declining, and quite recently it's becoming more uncertain, which increase pressure to move forward to domestically finance social protection system in many developing countries. And all in all, these trends imply that the dominant previous model of expansion of social protection systems, which was mainly supported by external finance, is less viable. Before I think discussing the different option in terms of financing and the challenge, I think it's important to to remember why social protection matter. As Prof mentioned before, there is a strong empirical evidence that shows that social protection actually plays an important role in reducing poverty and inequality. It also stabilize, consumption during shock. We also have strong evidence that supports that social protection are actually very important for human capital accumulation through improving schooling, nutrition, and health outcome, which is a backbone of future development and economic growth in any economy. It also strengthens, resilience of households and individuals by helping, households to cope with shock without restoring to distress strategies, such as liquidating, productive assets. And in weak labor markets, such as the labor market in South Africa, social protection plays a macro stabilization role, sustaining demand and reducing, long-term scaling effect. So in general, social protection should be, seen not only as a redistributive mechanism, but also as a development investment. We have overwhelming empirical evidence, that supports their effectiveness. Here I'm just summarizing the overall idea that I discussed in previous slide. In general, social protection operates through three interconnected channels. The first one is protection, which reduce poverty and support household consumption. The second channel is productivity, which enables investment in human capital and labor force participation. The third one is, resilience, which support or help households to absorb shocks, such as drought, flood, or even food price. And these channels actually reinforce each other. So again, the key message is, social protection contributes not only to short-term welfare improvement, but also plays an important role to long-term development outcomes. So looking at Africa more broadly, we observe that there is some progress, which I will discuss briefly, and we also face persistent constraints. As most of social assistance in general has expanded significantly. And currently many African countries have some sort of cash transfer or a safety net program for the most vulnerable within their territory. However, coverage remains limited, and contributory system, which makes these systems more sustainable in the future, remains shallow. Mostly because of informality and low level of income, which we need to mobilize resource domestically. Because of this, many social protection system remain dependent on donor financing and run through parallel structure. So the central challenge is not only just expansion, improving coverage, but how to finance and institutionalize those systems sustainably is also becoming quite an important issue. This figure just shows the coverage gap across regions. As you can see, Africa remains far behind from other regions, let's say from Latin America and Europe, for instance. This means that social protection is still very thin, despite its expansion. And it's very small and thin in a context where vulnerability and poverty is quite high. And the policy challenge is actually, threefold, right? So we need to expand coverage, and at the same time, we need to ensure, that this expansion is sustainably financed domestically. Yeah? This figure shows, the spending gap. African countries typically, spend around 2% of GDP on social protection, which is quite low compared to, Latin America, which is about 10% and 60% in Europe. Reflecting, both limited physical space and different welfare structure across the region. But this has a very important implication because low spending means, that programs are often small in general in scale, with a very limited benefit size to bring, welfare change, and it has a limited data. So again, the issue is not only improving coverage or expansion, but whether the systems are adequately financed to be effective. At the same time, the macro physical constraints have tightened in many countries. Physical deficit increased during the pandemic and remained, high. Debt levels have increased, and higher interest rates have, increased debt service costs. And in many developing countries, and particularly in Africa, debt interest payments are now, crowding out social spending, which have a long-term, effect on growth and development. And this creates really a difficult trade-off between, physical consolidation and maintaining, welfare commitment. In parallel, we are witnessing, a decline in donors' contribution. The external financing environment is, changing quite quickly. Official development assistance is declining for quite a long time now, and recently it's becoming more volatile. And donors are also shifting, priorities, which creates uncertainty for many programs in the region, and will have a negative effect on welfare. So specifically for social protection, this does not only mean that, we have less funding, but it also makes, planning of those systems very uncertain, and there is a delivery risk as well. So the financing problem is both quantitative and it's also, institutional. So from all this trend, what follows is that, we are in the era where there is a new social protection financing reality. The era of the donor-supported expansion is clearly ending, and countries must increase, relying on their own resource or domestic financing. And social protection must compete with, national with the national budget. And this actually makes South Africa a very particular case, because we already have, a matured, big social protection system, which is largely, financed domestically. Yeah? So as most of you know, South Africa operates one of the largest and most institutionalized social protection system in Africa. According to, I think, recent estimates, it covers about 18 million beneficiaries with a relatively well-developed administrative system. And most importantly, in terms of, financing, it's domestically financed. And the debate, I posed in previous, slides now shift from expansion more to sustainability and policy trade-off. Again, it's important to remember, that social protection plays an important role in improving welfare. I think the South Africa case is very important, and we have strong evidence. We know that social grants improve educational outcome, children nutrition, and children health. It also supports, labor market participation and reduce a constraint on job search. They also strengthen, household bargaining power, particularly for women and elderly, and generate, local economy spillover. The evidence clearly shows, those grant programs actually work in terms of improving welfare. There is some emerging evidence which suggests, unintended consequence of social grants, such as the child grant, for instance, on teenage pregnancy, for instance, right? But all in all, we know that social grants in general work in South Africa to improve welfare. So, given this evidence, now the issue is no longer whether social protection is effective or not. But the real challenge is how to maintain, adequacy and coverage under, raising debt, weak economic growth, very high and persistent unemployment, and expanding social demands, right, due to vulnerability. And I think this is why, the debate around grant and basic income in South Africa is fundamentally, a financing debate rather than, its effect on welfare. This figure clearly shows, our physical pressure, right, in South Africa. As you can see, public debt has increased significantly, and according to IMF, it reached around 75% of GDP in 2024. Reflecting both structural constraint and the recent big shocks, such as, the COVID pandemic. And the key implication is that, we have a physical space with a very, limited potential for expansion. So the policy task becomes, more balancing protection with financial sustainability and credibility, which leads to the core policy trade-off. On one hand, there is a need to expand social protection to address the persistent unemployment and vulnerability in our country. On the other hand, there is a need to maintain debt sustainability and credibility. Yeah? And this implies, a medium-term balancing strategy, rather than short-run fixes. So the question is, how can social protection be financed sustainably under this condition, right? For me, there are four options, right? The first one is to raise revenue, local revenue, improve efficiency, or spend the existing resources we have on our hand in a better way. It needs reallocating of spending, and we can also have or there is also a room to use external financing more strategically. Yeah? So in practice, I think we need or sustainable financing requires a combination of those tools. I don't think there will be a single option which would be sufficient. Okay. And the goal is to build a system that is domestically anchored and also flexibly supported. I will skip the detail on each option because it will be addressed by the next speakers. But then let me just say something. What does it imply for South Africa in particular? And I will conclude. So for South Africa, I think the key constraint is physical, and a realistic strategy to finance a social protection system requires better revenue allocation, a careful reprioritization of our spending. We need gradual expansion, and there should be a very strong link of social protection and labor market policy. And our policy takeaways are, we need to protect core social spending during this physical consolidation, and we have to move towards integrated system, and we need to combine revenue efficiency reforms, and we need to focus on sustainability and adequacy in South Africa. And there is also a serious need to shift donors' role towards financing or strengthening the system instead of using it directly to finance social protection. So to conclude, it seems like the era of externally financed expansion of social protection is ending in many developing countries. Social protection remains very important and essential, but financing now requires hard physical choices and a strong institution. In Africa, the challenge is to build nationally financed system, and in South Africa, the challenge is to sustain and deepen the already existing large system. And all in all, I think the bottom line is social protection remains a key for development, but financing it sustainably is now the central policy challenge for many African countries, including South Africa. Thank you very much.
Thank you very much, Eleni. Thank you for giving us food for thought and for sharing such insights. Yes, clapping hands for you there. Let's move on to Andrew. Andrew, over to you for your 15 minutes.
Okay, thank you very much. I need to share my screen, so I need to if we can just end the previous sharing. Okay. Right, there we go. I can share now. And here we go. Professor Chitiga Mabugu and Dr. Yeberek have set out the context very well, and I'm not going to spend more time on that. They've emphasized the context in which South Africa has to think about its next steps in social protection, very high unemployment, a very unequal society, but as Dr. Yeberek has emphasized, a world in which fiscal resources are constrained, access to donor finance has never been particularly important in South Africa's social protection, but it is becoming more constrained everywhere. And so some of these issues are particularly pertinent in the parts of our social protection system. I'm thinking of some aspects of our health services that have been reliant to some extent on foreign assistance. And this is the context in which there are, and this is perhaps what I would like to elaborate a bit more on, a context in which we need to take into account the institutional legacy, the institutions we have, on which we might be able to build in next steps in social protection. Just this, thank you, Gilad. Okay, I think this is a helpful reminder, both an illustration. These estimates, which come from the IMF, are quite out of date now, but they illustrate the high inequality and so the importance of redistribution in our context, but also the unusually high reliance of low-income households on social grants. So wages or earned income accounts for by international comparison, an extraordinarily low proportion of the income of low-income households. And so I think that has implications for how we think about the next steps in social protection. And what I'd like to emphasize is that we've got to look for strategies in which the complementarity between earned income and social protection or income sharing are greatest. And I think that takes us to reform options that have been on the table for a long time. I'm going to talk really about the argument behind the key recommendations of the Taylor Commission 25 years ago, which put at the center of our social security reform strategy or comprehensive social security strategy, the building over time of our contributory social security. I'm going to emphasize that by international comparison, contributory social security is the weak link in our system. It's the least developed part of our social protection framework. And so our next steps in reform need to be to find ways of implementing, expanding the contributory social security system. A reminder here of what the Treasury often emphasizes, that 60% or so of non-interest spending goes to what the Treasury calls the social wage. Of that 60%, which is around 16% or so of GDP, social protection as classified in the government accounts is about a quarter. And that's mainly social grants. And you can see the numbers there. Social grants about 280 billion rand in the fiscal year that's just coming to an end. If you add to that social welfare spending, you get to around a quarter of the total social protection budget. And I think that when you look at these numbers, you have to say there's not much scope. This is sort of my sense of these numbers. There's not much scope for reprioritization here in favor of income support to households, because it would be at the expense of fundamental social services, education, and health, which account for about half of the total here. But notice also that employment programs are a very small part of the social protection landscape. Underestimated in these numbers because quite a bit of the employment spending is elsewhere in departmental budgets. But even if you generously estimate the contributions to employment programs that come from the Environmental Affairs Department and others, you get to a comparatively small percentage of either the budget as a whole or of social protection spending. And then I also think it's important to recognize and important to recognize in thinking about prioritization that we really don't spend anywhere near enough on investing in what I've called here household assets. We're nowhere near spending enough on support for housing development. We're very conscious these days of the shortcomings in infrastructure maintenance in municipalities. They are to some extent self-financing, but they do rely to a considerable extent on budget resources. And both in the interest of growth, but also in the interest of raising living standards, we are going over the period ahead. We're going to need to spend more on infrastructure, housing, and more broadly household assets. And as many people here will know, Michael Sachs has written an interesting paper recently in which he's arguing exactly that our thinking about redistribution, our thinking about development policy needs to give more priority to, needs to give more emphasis to investment in assets, investment in household assets. Now, when you think about what social protection comprises, one way of breaking that down, one way of classifying that is to distinguish between state programs, non-contributory and contributory. Our social assistance program is essentially non-contributory. That's the very large one. We also have several social security funds, and I'll show you some numbers there. They are a comparatively small part of our system. And then labor activation and employment programs. We're not going to be talking about that particularly today, but those who've looked at these programs are now, I think, quite rightly pointing to the fragmentation and the weaknesses of of a system that has so many components, over 100 labor activation programs, if you add them all up, that on my estimates, maybe actually create in some sort of permanent sense around 50,000 jobs a year, thinking of the kinds of things that are supported by the Jobs Fund and perhaps small enterprise development programs, and our employment programs that create temporary job opportunities or employment opportunities that continue to rely on government funding, which support, on the best estimates, around 300 to 400,000 full-time equivalent work opportunities at present. So in our employment numbers, that's the sort of maximum number of jobs that are associated with the government's public employment programs. I think they need to be expanded. I think we could be doing better in these employment programs, but they're not going to solve the overall job strategy, and so an employment strategy needs to have other elements. But social protection more broadly also includes arrangements that in many countries are done through statutory programs, statutory social contributory social security programs, but in some countries are done through regulated contractual savings. And so those who work in this area of policy recognize that some parts, at least, of what is funded through pension systems, provident fund type arrangements that are private funds, privately managed. They're not managed by the state, but nonetheless serve a social protection purpose in income smoothing, and in well-structured systems also can contribute to redistribution in important ways. And I'm going to just share with you some numbers that give a sense of the balance between these things that seem to me to provide the kind of background evidence that we need to think about where the next steps in reform should go. And as I've indicated, I'm going to suggest that those should be in building our contributory social security system. Broader coverage of our retirement funding, pension and provident fund system would certainly require some form of statutory social insurance. And that was the centerpiece of the Taylor Committee report of 25 years ago. Many of you will know that there has been work of an interdepartmental committee and draft, at least, green papers or white papers that have been prepared and published and discussed, even in NEDLAC in recent times, but we've not yet found the way forward for implementing these. Why is the retirement fund system, as it exists at present, not adequate? And these numbers just give you a sense of that. Out of 16 million or so people employed, and the numbers have not changed very much since 2020. We've had the COVID decline and then recovery over the last few years. Around half are retirement fund contributors, slightly less than half if these estimates are right. And unsurprisingly, in the formal sector, coverage of the pension provident fund system is quite high, over 90%, very low in respect of informal and agricultural household workers, and of course, much lower in income levels below the tax threshold, because this is a tax incentivized system. It's advantageous in informal employment. There are typically pension or provident fund arrangements in place, but they seldom extend through to incomes in retirement for those who are even contributors during their working years but earn below the tax threshold and typically take their benefits before they reach retirement. So here's a reminder again, sort of an international perspective, thinking about different ways of providing for retirement, but also providing for unemployment and other death and disability insurance, household income security internationally. Most countries have some blend of a mandatory system that is funded through or a system that's funded through the budget, that's our social assistance, mandatory contributory arrangements in the second tier, earnings related, so contributory arrangements in which benefits are tied to income in some respects, and then also encouragement through the laws, often through tax arrangements, of voluntary savings and income protection arrangements. There are different ways in which these can be organized. I'm not going to spend much time on that. Now, I really just want to share some sense of the overall size of all of these arrangements. And so we have three large social security funds. Amongst the compensation accident insurance arrangements, there are actually four different schemes in place, but the largest is managed by the Department of Employment and Labour, the compensation fund that provides protection for most formal sector workers. And these are the sort of income flows and benefit payments out of these systems. The Unemployment Insurance Fund, income from contributions of about 27, think of it as about 30 billion rand a year now. It's paying benefits that are more or less equivalent to that, but it has other expenses as well that have increased very sharply. I am worried about the Unemployment Insurance Fund. I'm worried about the rise in its other expenses. And I am deeply concerned about the extension of the, if you like, mandate of the Unemployment Insurance Fund that we've seen in recent years, where it is increasingly spending money on trying to save jobs in businesses as opposed to providing income support to those who lose their jobs. And it has lost a lot of money in bailing out enterprises that have failed. And I think we really need to be cautious about that kind of extension of the activities of a social security arrangement. Effectively, we have a UIF which has large balances of money in the bank and is beginning to use it for purposes that are indirect, that are secondary to its core income support functions. I think one should, I think that that's a dangerous route to go down. And so in thinking about in thinking about our social security reform options for the future, I would argue against trying to use the UIF for job creation programs, etc., which are not its core business. Compensation fund also has spent an extraordinary amount of money relative to its income in the last few years in trying to modernize its systems and expand its own internal employment. I'm not confident that it's on the right track there. I think that also needs to be put under the spotlight. But again, just looking at these numbers relative to the whole fiscal system, bear in mind that close to 300 billion that is spent on social assistance grants. These programs are not particularly large. These social security arrangements, as they exist at present, do not provide substantial amounts of income support to low-income households. They are really categorical programs that are aimed at particular purposes. And then lastly, a very different category of social security and social insurance institution, deeply in need of reform, alongside the Taylor Committee report of 25 years ago, the Satchell Commission of Inquiry into the Road Accident Fund made recommendations for a transition of the Road Accident Fund into a social security type benefit scheme. We've not completed that reform, and this is an institution that is in huge financial trouble. And just bear in mind the numbers there. It is double the size of the Unemployment Insurance Fund, roughly, or its equivalent to all the other existing social security arrangements added together in size. It's reliant on a fuel levy, income that is paid through fuel taxes. In time, that is not going to be a satisfactory way as we move towards electric vehicles and so on. That is not going to be a satisfactory way of funding road accident insurance. And so for several reasons, there is a need for reform of this fund. Now, I'm not going to say anything more about the reform of these arrangements. I want to talk about the thing that is missing from these social security arrangements. But alongside those cash flows, revenue and benefits of the existing funds, bear in mind the size of their assets under management. The UIF has made surpluses over quite a long period of time, really since it was reformed about 25 years ago. It has around 160 billion in the bank. Not all of that is a surplus because it has some liabilities that have to be recognized for people who have lost their jobs but not yet received benefits. Compensation fund also has substantial assets under the management of the Public Investment Corporation. But the Road Accident Fund is essentially bankrupt. It has an accumulated deficit. In other words, accidents that have happened for which claims have either not yet been submitted or have been submitted but not yet settled, are still being disputed in the courts, add up to, on actuaries' estimates, some 360 billion rand. So this is a huge financial liability. It is absolutely the largest single problem on South Africa's sort of government balance sheet, if you like. And this is a reform that has been deferred and deferred and deferred in Parliament for far too long, and needs to be addressed with considerably more urgency than we've seen. Now, I want to move from those social security arrangements to our retirement fund system. And bear in mind here that this is essentially a earnings-related system in which there are funds that are operated in terms of laws that provide for the pensions or other benefits, death and family benefits for those who lose their lives or are disabled in the public service, largely through the government employees pension fund, and in the private sector through a very large number of funds that are either privately administered as by the trustees of retirement funds created by bargaining councils or other institutional arrangements, or what we call underwritten funds, which really means the retirement funds that are operated by life officers, by the life insurance companies. These are funds in which annual contribution flows add up to around 300 billion, somewhere more than 300 billion now a year or so. And that's an interesting kind of comparison to bear in mind. We have a retirement fund system in which annual contributions into funds are of the same order of magnitude as what government is currently spending on social assistance grants, something like 4.5% of GDP going into contributions to retirement funds, pension and provident funds, something like 10% of the salaries and wages paid to employees.
Andrew?
Benefit payments? Yes.
Andrew, just to say,
yes.
I hope you're coming towards the end.
Yes. Oh, dear goodness me. I'll chase through these last little bits and get to my concluding points. Okay, thank you. So again, just a sense of magnitude. Benefit payments from these funds, far too much going into lump sum withdrawals from funds, as opposed to incomes in retirement. There have been regulatory changes in recent times that will lead to change in that over time, so we're going to see better preservation in the system. But what is missing from this arrangement, as we all know, is a statutory standardized arrangement in which the complexities of the existing pension and provident fund industry are avoided, in which benefits are governed by law, and in which standard contribution rates apply. Okay, assets under management of these funds, around 6 trillion rand, so about 80% of GDP is managed by retirement funds. And really, let me just finish with these couple of slides on social security reform. I'm not going to go through this because I think most people in the discussion are familiar with this. I like to emphasize how moving towards a contributory pension fund system has to be accompanied by a wage subsidy. You've got to subsidize contributions in the bottom of the income distribution or below the tax threshold in order to avoid the funding arrangements, payroll taxes that fund contributory arrangements, becoming an incentive to informalize businesses. Put in place a wage subsidy, and the system becomes a way of encouraging formalization of businesses, and that is absolutely a key element in a reform strategy in this direction. And I have a few slides here that just illustrate international perspective. There are many ways in which these things are organized internationally, so that you can see quite a considerable amount of variety internationally in the balance between private pension arrangements and public and total pension arrangements. and quite a lot of variety internationally in the rates of contribution that are required. But something like 10% of income going into a mandatory or a system of retirement provision governed by law it would be fairly typical internationally. So these are the key design parameters. These are simply features of the arrangements that have been under discussion for many years between the Department of Social Development, Employment and Labour and Treasury. It's both about pensions and about broadening disability and survivors benefits and unemployment benefits. And I've drawn attention already to some of the key transition issues that need to be addressed. And this is the last couple of slides here. I think it's important to bear in mind that both Social Security reform and health insurance are looking for additional funding sources, and a balance needs to be found between those. And this is my concluding point. Where I want to get back to what I started with, that one needs to think about Social Security reform in terms of the complementarities that can be found, the ways of supporting growth, redistribution, and better income security alongside employment in an economy in which unemployment is such a central determinant of poverty and inequality. Thank you very much. I've taken a little longer than I should have. Apologies for that.
Thank you very much, Andrew. Very stimulating. Let me move on directly to Gillett. Please go ahead for your 15 minutes. I will also show my face once it's time, please.
Yeah. Excellent. Thanks very much, colleagues. And apologies for my raspy voice. I've been a little bit unwell. I was asked to speak to progressive taxation as a vehicle for funding social protection, with a slant on the issue of a basic income. So I'm going to stick quite narrowly to that, but happy to engage on other issues later on. So I'm going to just share my excuse me, sorry, that's the wrong button. Slideshow, there we go. Okay, I'm assuming everyone can see my screen. So I would start off by raising a few broad points around funding social protection in general, and the potential for expanding that through a universal basic income grant. I share the sentiment that's been expressed by the other speakers that these debates have come to revolve around the questions of financing. But I want to start off by actually interrogating that and suggesting that that might be placing an unfair burden on Social Security in general. And what do I mean by that? Well, when the Minister of Finance announced the 1 trillion to be spent on funding infrastructure, nobody asked, where's that money coming from? Will you please show me that there is a dedicated funding stream available for that funding? What was just accepted was that this was a necessary expenditure, and therefore it would be funded out of the fiscus. And so in some ways, expecting us to find ring-fenced funds for Social Security is a burden on this, and a way of sidelining it, which is potentially unfair. I am, however, going to focus on areas where I think additional tax revenue is available. It's important to say that this should be funded, if implemented, through progressive tax means, not through things like the expansion of a VAT or other indirect taxes, which disproportionately burden poor and low-income households. There also is a debate about whether it's appropriate to ring-fence funds in this way, or whether this is just about finding ways of increasing the fiscal pot as a whole. I should also say that the costs need to be thought of not only as a gross cost, i.e. what the fiscus pays out, but that there is some funds returned to the fiscus, in particular through the spending of social grants on VATed items, for instance, or through the multiplier benefits of such spending. What I'm going to present here is more of a menu of options rather than a suite of recommendations. So it's not that I'm necessarily recommending all of these things should be implemented simultaneously. Lastly, I think it's important to recognize that when talking about tax increases, we have to recognize that the public is correctly a bit jaundiced against this because of the ineffective and corrupt spend of existing resources, and that needs to be met head on. So I've got 7 different funding sources, just to say this all draws from work which our institute undertook 4 or so years ago, which I've updated for this presentation. Some of that updating was very precise. Some of it was more estimates. In my last slide, there's an explanation of all of the methodologies followed, and I can circulate these. So the first, so this just looks, we've already heard what share of the a budget Social Security occupies presently, and I won't go into that, but this looks at different scenarios for a basic income grant in line with the food poverty line, the lower bound poverty line, the upper bound poverty line, or higher levels, and offered to ages 18 to 59, either to everyone or if uptake is lower than everyone, as it is with most grants, or to subsections of the population, either the unemployed, the not economically active, or those not in informal employment. And it does indicate that a grant of this type would place a significant funding implications for the state. We then have these sort of 6 options here. So the first, which we proposed, is a Social Security a tax, which is a dedicated tax to fund Social Security. It is levied at a sliding scale of between 1.5% of taxable income upwards to 3%. We estimate that this would raise in the region of 100 billion each year. It's a progressive tax. It's easy to administer as an add-on to income tax, even though it is levied on all taxable income. The lowest income earners are still net beneficiaries, in the sense that the income grant is of a higher level, even at the food poverty line, than they would pay in this tax. What it allows is for universality in the grant, which is shown to have various benefits, but to then claw back those funds from the middle and upper income, and it would lead to a substantial but manageable increase in effective tax rates of about 3 percentage points. It's possibly because it does impact all taxable income, isn't as progressive as some of the other options. Next is the potential removal of various tax breaks. In particular, we look here at the selective removal of the retirement fund contribution for those earning over R1 million, and the removal of the medical aid tax credit for those earning over 500,000 rand. This, once again, is a highly progressive measure which is targeted at those incomes shown. What's important to bear in mind, I mean, you could think about a tax benefit as essentially a social grant for taxpayers, right? It is money which you and I receive back from our taxes. The average benefit for retirement fund contributions to those earning above R1 million exceeds 6,000 rand every month, which is obviously far more than any of the proposed income grants. Similarly, the medical aid tax credit is of a higher value currently than the existing SRD grant. This is also easy to administer. There's a potential conflict with the fact that the medical aid tax credit has been earmarked for NHI funding. And as you can see, this would raise around 14 billion rand. The next is the institution of wealth taxes. The estimations here work off a net wealth tax of 1% for the highest earning, for those with the highest accumulated wealth of 1 percentage point, and 3% for the ultra rich at the highest 0.1%. So that's those earning above about 4 million and above 29 million. This raises around 65 billion rand. This is pretty much in line with the international. I've listed some countries there who have raised between 0.2 and 1.5. So 65 billion is just under a percentage point of South Africa's roughly 7 trillion GDP. So the estimates make sense. We also have proposed an increase in the estate duty tax and in a dividend tax to align those better with income tax brackets. This has also been shown to improve investment spending. For instance, in a French study showed that. The wealth tax in particular would require work on the administrative side, on enforcement data, and a cross-border collaboration. Sorry, that shouldn't say wealth taxes, but next we look at taxes on financial transactions of various sorts, either on currencies or on security transfers or on all financial transactions. These taxes exist and are in place in a number of developed and developing countries. These show positive benefits on reducing speculation and volatility and improving on flows towards real fixed investment. The impact on the transactions themselves and on the market is admittedly uncertain, but we do have a number of international case studies we can follow. Second last is the removal of existing corporate tax breaks. There is both the illegal avoidance of a tax, for instance, through a profit shifting, but we also offer various tax subsidies, which is an important policy a tool, but we would argue in certain instances is being used ineffectively. In particular, the employment tax incentive, which is serving as a subsidy to a business, and which various research studies indicate is quite ineffective at actually expanding employment. And we look at the reversal of the recent corporate income tax reduction, which has failed to improve investment in any meaningful way. Lastly is the consumption taxes, in which we look at the potential for the implementation of a increased VAT on luxury items like yachts and a private swimming pool equipment, as well as a more robust approach to a carbon tax, which again combined would raise in the region of 12 billion rand. So we would argue that this indicates that there is room in our tax system to increase revenue. This is my last slide. I think that this is obviously not simply a question of financing, and one needs to, when thinking about financing, think both about costs and benefits. And we've heard this from the earlier speakers, that the evidence indicates that expanding social security lowers poverty, stimulates economies, supports work seeking, improves human capital, lowers gender inequality, and is less prone, because it's money in the hands of individuals, to the types of corruption which we see, although of course there are other forms which that it emerges. What we've also seen is that there's significant evidence of the long-term multiplier benefits of such spending, which would then increase growth and increase the taxes over time. Ultimately, whilst I would argue that there is room in the a tax system for increased revenue generation, nothing is going to improve revenue more than improving the quality of the existing spend and ensuring that our fiscal and macro policies are accelerating growth, which is the sort of ultimate means of expanding the purse. Fiscal policy is ultimately a question of various trade-offs, and in a country where over a third of the population suffers from hunger, we need to ask whether it's an acceptable option not to provide for the expansion of social security. Thanks very much.
Thank you so much, Gilad. Thank you for giving us very concrete ideas there and combining all the different presentations also from Andrew. We can really come together and put up a policy document, in my view. I mean, notwithstanding that these things have already been said. I'm aware that we are running out of time, so I want to come to, so colleagues, I assume you've been typing away your questions and your comments, and my colleagues in ASSAf will help me here. So far, I see on my side one comment or question. Neil, that's from Neil. Rosanne, can people talk or must I read out what they're saying? Just remind me again, please.
They can do either, Prof. They can either talk or you can read through the question.
They can talk. Okay. So Neil, would you let Neil talk, please, if you want, Neil?
Prof, I think the questions are fairly straightforward.
Okay.
But in addition to the question to Andrew, I also wanted to ask if Gilad could say something about the issue of the gross costs versus the net costs of introducing basic income. Thanks.
Thank you. So Andrew, over to you. Just very short answers, please. We have just about 8 more minutes, and then over to Gilad on that question as well.
Andrew? Yes, let me, and I haven't looked at all the questions yet, but Neil has asked about the UIF. So Neil's question is, the UIF benefits are comparatively low. Should we be raising the benefit levels of the UIF? And so we have quite an unusual benefit structure in our unemployment insurance fund because we have a sliding scale. So the percentage of your wage that you receive in the UIF benefit is a declining sliding scale depending on earnings level. And so I do think that there is potential there for improving benefits without endangering the solvency of the fund. But I think the most important thing that I would like to see in unemployment insurance reform is the introduction of some form of continuation benefit beyond the 12 months that are presently available in our credit-based UIF system. If you're, and particularly, I think, if one was to face trade-offs here, I would say that workers who lose their jobs above the age of maybe 45 or so have a very low probability of finding their way back into the workforce, particularly if they've been employed in mining or in sectors in which demand is falling or employment is falling. And so I think some kind of flat rate continuation benefit should be funded through the UIF and should be part of the system that bridges the gap between losing a job under circumstances where you have very little prospect of getting back into the labour market and qualifying for the old age grant. And just to reinforce my point, earlier point, I don't think that the UIF should be getting into the business of job creation or these rather complicated temporary assistance to businesses that are in difficulties. I think they're unworkable and they're open to various kinds of abuses. Neil, I also think that the UIF contribution is the natural revenue base for a broader comprehensive social security system. In other words, if we were to build a statutory or a standard pension benefit or retirement benefit into our social security system, you would do it through the UIF and raise that contribution level over time. And it helps to do that through a fund that is already well capitalized. I think it makes the transition to a comprehensive social security easier. That's partly why I would want to preserve rather than spend the assets of the fund in its that it presently holds.
Thank you, Andrew. Gillard, anything on your side that you want to add? I see you have posted your there's the slides. I also know that through ASSAf they will be shared as well as the recording of this meeting.
Okay,
Please
great. So very briefly, I didn't have time to update the various data on gross versus net costs. I'll explain the logic. The logic is that a portion of the outlay is recouped very immediately, in particular through VAT. We estimate that about 12% of the income grant would be recouped in that way. That's obviously lower than the headline VAT rate of 15%, but that's because only a share of income is spent on VATable items. So that already lowers costs by over a tenth. And then, of course, there are other ways in which all fiscal expenditure has positive multiplier effects, maybe not all, if it's being siphoned off to accounts in Dubai. But all good fiscal expenditure would have multiplier effects, which would expand the economy in ways which generate taxes. There was one other question in the Q&A to me, which I'm not sure I'm 100% understanding, but there is a process of each year in the budget process of the Treasury trying to account for the cost of living issues. I'm not sure what you mean by the cost of living increase, if you're referring to whether the wage increases by a certain amount each year or the pressures from living costs rising. So maybe I'm not sure I can answer that because I'm not sure I'm fully understanding what's being asked.
Thanks, Gillard. Melusi, are you still in? Maybe do you want to just quickly elaborate? We're just having 2 more minutes now.
No, thank you, Chair, and thanks to Dr. Isaacs. Yes, I was just asking that through the Treasury process, is there now a progressive, or maybe annually, or maybe every 3 years, a process that then re-evaluates the magnitude of taxing to compensate for the loss of value due to, the rising cost of living? That is what I meant.
Yeah, so those evaluations are made annually, where the various tax rates are adjusted. the various rebate rates are adjusted annually, the various tax brackets and how you fall into that are adjusted not every year but many years. So there is a whole suite of adjustments made annually to various tax items, which would account for revenue needs and increased costs faced by taxpayers. Andrew would have more like nitty-gritty insights into that, but yeah, I mean, I think that is a part of the like normal budgeting process.
Thank you very much, Gilad. Just last question, Kat, do you want to say something here, or do you want us to just read what you say about the complementarity of these two scenarios? Catherine? So Catherine says, maybe she's still muted. Catherine Hall, could you let her speak, or I can just read the question? Andrew's scenarios for contributory social security and Gilad's scenarios for UBIG financing don't seem to be mutually exclusive. Contributory systems rely on higher levels of employment, and we would need to accomplish that first. So agreed there. Andrew, what do you think of Gilad's scenarios and options? So Andrew,
well, I mean, Gilad has done what he was asked to, which is identify quite a number of possible ways of raising the tax burden, with in mind a non-contributory basic income grant or broadening of the social relief distress grant in mind. I do think that building the contributory system is a different strategy. So, I mean, yes, you could be doing both. You could be strengthening social assistance and strengthening the contributory system, but they are different systems. They have a different logic to them. And Professor Chitiga Mabubu put that number right at the start of this 1%. No, it was Eleni Ibrek who put up the 1.5% or so in spending out of GDP in Africa on social protection versus 16% in Europe. Most of that 16% in typical OECD countries is the lifetime income security and protection against unemployment that is associated with the sort of income smoothing pension fund arrangements.
Thank you very much, Andrew. We've come to 15:30. I see that, Andrew, you have already been adding points, Eleni as well. So colleagues, thank you so much. Let me first thank our speakers, Eleni, Andrew, and Gilad. This was absolutely stimulating. As I say, it gives us, some of us who are researchers, food for thought and some work to look into. So well done. Thank you very, very much. To our audience, thank you very much. I hope you enjoyed this. And as said, this will be shared with you. So I see everyone is clapping. Well done. Thank you. To my colleagues in the standing committee, thank you for being here. I can see some of you. And then finally, just to thank the chair of our committee, as well as the colleagues in ASSAf who have helped us to put this webinar together. Thank you. This was wonderful, and go well. Good afternoon.